At Starlight Capital, we build concentrated portfolios of high-quality businesses when they offer us enough return for the risk that we are exposed to. Our goal is to deliver superior risk-adjusted returns over the long term. We call our approach focused business investing, and it has served our clients well for over a decade. To us, a high-quality business is one that generates strong recurring free cash flow from a collection of irreplaceable assets financed with low leverage and led by a management team that behaves like owners and treats you like partners. Let's examine each of these variables, starting with cash flow. Now, I've heard the saying, cash is king, many times. Well, if cash is king, then cash flow is divine because it gives your business life. Any business that doesn't generate positive, recurring free cash flow is just a collection of liquidating assets. We pride ourselves on being long-term investors and avoiding these scenarios. Irreplaceable assets come in many forms, from Union Pacific's tracks to Google's brand. It is these irreplaceable assets that form a moat around a business and allow it to compound capital at higher rates. Commodity businesses lack irreplaceable assets and so have no moat and no ability to compound capital at higher rates over the long term. Leverage can be utilized effectively by almost all businesses. However, we prefer businesses with less debt in their capital structure because it reduces the volatility of the business's cash flows and margins over the course of a cycle. All else being equal, less debt means more free cash flows available to fund dividends and stock buybacks and boost shareholder yield. Finally, management is an important variable that is often hard to gauge. We have found that the best management teams are happy to disclose accurate information on the firm's operations and outlook. They act as stewards of capital instead of financial pirates, and treat investors like partners in the business. These management teams are more likely to be great allocators of capital over the long term. No discussion about investing is complete without discussing risk. We see risk as the potential for permanent losses of capital. We invest people's hard-earned capital in equities, which are inherently risky. We have a duty to ensure that investors are adequately compensated for taking that equity risk. Our process is designed to minimize risk before and after making the investment decision. We start by only investing in high-quality companies, which reduces the likelihood that they report extremely adverse results. Next, we only invest in companies and industries that we understand, which reduces the likelihood of making valuation errors. We only invest when there is a large margin of safety, that is, when stocks trade below intrinsic value. And finally, we scale positions based on our level of conviction and the return potential of the investment. After we initiate positions, we continuously review the company's operations, we meet with management, we travel to view the operating assets, and we update forecasts and estimates. When we are wrong, we recognize it and move on. And when we are really right, we try to preserve capital by selling when the return no longer compensates us for the risk we're exposed to. We are constantly on the lookout for unintended correlations in the portfolio that could expose us to larger than anticipated losses. For this reason, we don't invest thematically, because we do not want to turn our portfolios into levered bets on an uncertain outcome. Focused business investing is a disciplined investment strategy that has served our unit holders well for the last decade, and I'm confident that it will continue to do so in the decades to come. We invite you to partner with us for the long term as we build Starlight Capital.